Welcome to ALU Speaks with ALU Patience. Today we'll be discussing on the topic cash flow statement in the course Introduction to Accounting. The cash flow statement is one of the major financial statements we prepare at the end of an accounting period. It shows us how cash comes into the business and how cash goes out of the business during that accounting period. The cash flow statement is used to reconcile the difference between our cash balance at the beginning of the period and our cash balance at the end of the period. Information about the cash statement is covered under the International Accounting Standard 7, which states that the cash flow statement is a financial statement that shows the inflows and outflows of cash and cash equivalent during an accounting period. That is, it is a cash flow statement that shows the total receipts and total payments of cash and cash equivalent during an accounting period. In practice, when preparing our books of account, we use the accrual basis of accounting, where we recognize revenue as it is earned and expenses as they are incurred, irrespective or not whether cash has been received or paid out. And since our income statement represents what our business earned and incurred, and not what they received and paid out, it means that the income statement does not tell us about our cash inflows and cash outflows for that accounting period. That is why the cash flow statement becomes important. So we can easily see the difference between our cash flow statement and our income statement, as the cash flow statement shows the movement of cash during the period, while the income statement shows the profit and loss during that accounting period. Like we said, the cash flow statement shows actual cash received and actual cash paid out, while the income statement records income earned and expenses incurred, irrespective of whether cash was received or paid out. This means that the cash flow statement measures the liquidity of the business, that is the ability of the business to generate cash, while the income statement, on the other hand, measures profitability of the business, that is the ability of the business to earn profits. Since the cash flow statement focuses on the movement of cash, it does not include any non-cash expenses such as depreciation and amortization. But these non-cash expenses are included in the income statement so as to determine the profits for that particular financial year. The cash flow statement is prepared according to International Accounting Standard 7 on statement of cash flows, while the income statement is prepared according to International Accounting Standard 1 on presentation of the financial statement. When preparing the cash flow statement, we start by comparing the opening cash balance against the closing cash balance, and the difference shows either an increase or a decrease in cash for that accounting period. And we can get this cash balance information from the comparative statement of financial position. Therefore, the essence of the cash flow statement is to explain how we came about this increase or decrease in the cash flow. The cash flow statement is used to reconcile the reasons for this difference by explaining the various activities that led to this difference. That is the cash flow statement. It explains how the various activities of the business bring in cash and take out cash from the business. And these various activities can be classified into operating activities, investment activities, and financing activities. The operating activities, they are the core activities of the business. That is, they are the major activity, the major goal of that business. What I mean here is that they are cash flows arising from the normal day-to-day business activities of the business, such as the selling of goods and provision of services and its related cash expenses. Example of cash inflow from operating activities include receipts from customers, commission received, loyalty received, grant received. An example of outflows from operating activities includes cash paid to suppliers, rent paid, bills paid, office expenses, tax, and so on. Moving on to investment activities. These are activities other than our operating activities. What I mean is that these are activities outside the core activities of the business that also leads to inflow and outflow of cash in the business. Examples are the buying and selling of investments or the buying and selling of non-current assets, which are not the core activity of the business. That is, which are not the major activity of the business. Then we have financing activities. These are activities that relate to funding of the business and the repayment of such funds. That is, these are activities that relate to the receipt of funds and payment of funds. And these funds are usually raised through capital, that is through equity from the owners of the business, like through the issue of shares or share buybacks. And from this, we pay dividends to shareholders. Or through debts, that is liabilities to third parties, such as bank loans, debentures, and other long-term debt instruments, and which leads to a resultant cash outflow such as payment of interest. There are two main methods of preparing the cash flow statement: the direct method and the indirect method. The direct method shows actual cash received and actual cash paid out in our operating activities, investment activities, and our financing activities to show the increase or decrease in cash for that accounting period. What I am saying is that this method, it shows our actual cash receipt and payment of our core activities, our other activities, and activities related to funding of our business. Then we will compare this difference to the difference between our opening and closing cash balances. Sadly, this method can only be used if we operate on the cash basis of accounting, not the accrual basis of accounting. But because our books of account is prepared using the accrual basis of accounting, this method may be a bit tedious to use when preparing a cash flow statement. And this gave rise to the indirect method. The indirect method of cash flow statement is almost like the direct method. But what changes here is the way we derive our cash flow from operating activities. Because our operating activities was prepared using the accrual basis in the income statement. Therefore, adjustments have to be made. In preparing the operating activities, we start with the profit before tax. And because profit is not the same thing as cash, we must adjust it for non-cash items, non-operating items, and working capital changes to get the actual cash flow for operating activities. Let me explain. Non-cash items, they are expenses or income that affect accounting profits, but they do not involve actual cash receipt or cash payments. That is, although they appear in the income statement, no cash actually left the business. And since no cash was paid or received, they should not affect the cash flow. Therefore, they must be adjusted out. Examples of such non-cash items include depreciation, amortization, impairment loss, and increase in provisions. For instance, increase in a provision for doubtful debts. And since they reduce profits but do not reduce cash, we should add them back. Let me explain further using depreciation. We know that depreciation is simply an allocation of cost to a non-current asset over that non-current asset's useful life, as cash was paid when the asset was purchased, but no cash was spent when depreciation was charged for each year. Also, I said we should adjust for non-operating items. That is, items included in the income statement before the profit was derived. but does not arise from normal day-to-day core activities of the business. What I mean is that any activity that is an investment activity or a financing activity, but not an operating activity that was added in the income statement before the profit was derived should be deducted. The reason for this is that these items are already captured elsewhere, probably in investment activities or financing activities. So if they remain in operating activities, it simply means we have captured those items twice. We also said that there should be adjustment for changes in working capital. And we know from our previous classes that working capital simply means current assets minus current liabilities. This is simply an adjustment for the movement of working capital. We already understand that working capital changes simply shows how much cash has been held up or released from our day-to-day operation of the business. And the more current assets we have, it means that more of our cash flow is tied up, and this reduces our cash flow. And the more current liability we have, it means that more of our cash flow is released, and this increases our cash flow. So in a nutshell, when preparing the cash flow statement using the indirect method, we get our operating activities by adjusting our net profits against non-cash expenses, non-operating expenses, and changes in working capital. And to this, we bring in inflow and outflow from investment activities and inflow and outflow from financing activities. And when we compare this balance with the balance of the cash at the beginning and at the end of the period, we are said to have reconciled the cash flow statement or found out the reasons for the difference in the cash flow statement. Scanning through the illustration before us, we can see that this is a comparative statement of financial position for 2008 and 2009. We can see non-current assets for both years, less accumulated depreciation. We can also see a couple of current assets for both years. Going down, we can also see some details about the equity, non-current liability, and a couple of current liabilities for both years. It also has additional information where it states that Kate Limited sold a machine costing 1,120,000 that suffered an accumulated depreciation loss of 740,000 and was sold during the year for 465,000. The second information also informed us that 1 million shares of 1 naira per share were issued at par, and also that profit before tax for the year amounted to 2,556,000. We are obviously required to prepare the cash flow statement of Kate Limited. The fact that this question gave us a profit before tax figure, it means that we'll be preparing the cash flow statement using the indirect method. And the first step is to adjust that accounting profit of 2,566,000 into a cash-based profit. This question gave us a profit before tax. If the question had given us a profit after tax, we would simply adjust it back to profit before tax before using it. Why is this so? This is because tax is usually shown separately after getting operating profit. To this profit before tax, we would add back non-cash items. And the non-cash item in this question is depreciation. And to get the depreciation charge for the year, we simply find the difference between the depreciation at the beginning and end of the year. That is 3,150,000 naira minus 2,300,000 naira, which gives us 850,000 naira. However, there was additional depreciation during the year apart from those stated in the statement of financial position. That is the depreciation on the disposal of fixed assets as stated in the note of account,
to the tune of 740,000 naira.
And this will bring the total depreciation charge for the year to 1,590,000. Next is to deduct cash flow from non-operating activities. If any cash flow from non-operating activity was embedded in the accounting profits. And in this question, we were told that a machine costing 1,120,000 naira with accumulated depreciation of 740 was sold for 465,000 naira, and that the resulting profit from that sales was included in profit before tax. And we know that selling of fixed assets is not part of our normal day-to-day operational activities. Therefore, that profit from the disposal of assets that was included in profit before tax should be removed. And since the asset of 1,120,000 suffered a depreciation of 740,000, it means that the net book value of the asset at the time of disposal was 380,000 naira. Therefore, the profit made from the sale of that asset is simply sales minus net book value,
which is 465,000 less 380,000.
which will give a profit of 85 million. And we must remove this profit from cash flow from operating activities because it is not an operating activity but an investment activity. Adding this up, it will give us an operating profit before changes in working capital of 4,061,000 naira. Did you notice what we just did? We just converted accounting profit into a cash-based operating profit. Now, the next step is to find our changes in the working capital. Yes, we know that working capital is current asset less current liabilities. But when preparing a cash flow, we cannot calculate working capital in this way because using aggregate of current assets against current liability to calculate working capital only works for financial analysis. It does not work for cash flow statements. Why did I say this? This is because every item in the working capital has a different effect on cash, irrespective of if that component falls under current assets or current liabilities. What I'm trying to say is that please never use the overall figure of current assets less current liabilities to compute your change in working capital, but that you should compare them individually when preparing a cash flow statement. Now, looking at the current assets and current liabilities in the financial statements, let's examine them individually. Comparing inventory between 2009 and 2008, there was an increase in inventory by 1,688,000. And since buying inventory requires money, this will reduce our cash flow. Next is trade receivable. Comparing trade receivables of 2009 and 2008, there was an increase of 904,000 naira. And since this means customers are owing us more money and we have not received cash, it will reduce our cash flow. There is no need to compute working capital for cash and bank because cash and bank equivalent are the final result of the cash flow that we are trying to compute. If we include them in working capital changes, we will simply be counting cash twice, and that will be double counting. Next are the current liabilities. Trade creditors. Comparing the figure of 2009 and 2008, we can see that there is an increase by 104,000 naira. And since increase in trade creditors means we did not pay our suppliers, therefore, that means cash remained in the business and we will add it back to cash flow. This will give us net changes in cash flow to the tune of 2,488,000. And when we add this to the 4,061,000 naira, we will get a cash generated from operating activities before tax of 1,523,000. And from this, we will deduct our tax paid. Please, let's note that tax liability is not the same thing as tax paid. As tax liabilities, they are obligations the business owe, while tax paid is an actual cash outflow. And we can find our tax liability in the statement of financial position as they are current liabilities, while cash paid reduces the business cash balance in the cash flow statement. And also the tax found in income statement is tax incurred, which may not necessarily be tax paid. Therefore, to find our tax paid for the year, we would say opening tax figure at the beginning of the year of 580,000 plus tax paid of 735,000 less the closing figure of tax for the year, which is also 735,000 naira, which will give us 580,000 naira to be deducted from operating activities, and this will give us the net increase or decrease in cash flow from operating activities to the tune of 993,000 naira. Proposed dividends will be treated under financing activities as it is cash paid to owners for funding the business, and bank overdraft is also a cash equivalent, so it will be treated as such. So let's move on to investment activities. These are cash flows that are connected to activities of buying and selling of fixed assets and investments. And the value of fixed assets that was purchased during the year can be gotten from the difference between the opening and closing figure of non-current assets in the financial statement, and this is 3,820,000 naira. And remember, in the notes of account, we were also told that there was a sale of machinery to the tune of 465,000 naira. This sums up our net cash flow from investing activities to 3,355,000 naira. Moving on to financing activities. These are activities that relate to funding of the business and the repayment of such funds, as well as dividend payment. And from the question, we can see that between 2009 and 2008, there was an increase in equity by 1 million naira, and there was also an increase in share premium, and that loan capital dropped to 2,500,000. This means we have repaid part of our existing loans, and dividend paid is 800,000. Why is this so? This is because dividend proposed in 2008 is dividend paid in 2009, and therefore should be reflected as an outflow in our cash flow statement, meaning that the dividend proposed at the end of 31st December 2009 would remain a current liability in the statement of financial position, and this will likely be paid in the following year, that is in 2010. So we can see that the summation of cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities has given us a net decrease in cash and cash equivalents for the year to the tune of 3,662,000 in overdrafts. Now, to calculate the cash and cash equivalents, we deduct the closing figures of cash and cash equivalents from the opening figures of cash and cash equivalents to get the increase or decrease in cash and cash equivalents for that period, where the opening balance of cash and cash equivalents includes the balance of cash at hand, cash in bank, and bank overdraft figures for 2008. And the closing balance of cash and cash equivalents is the balance of cash at hand, cash in bank, and overdraft figures for 2009. So when we deduct the closing cash and cash equivalent balance of 3,707,000 from the opening cash and cash equivalent balance of 45,000, we will get an overdraft figure of 3,662,000 naira. Now, if we check the cash and cash equivalent balance drawn from the figures in the statement of financial position against the decrease in the cash and cash equivalent in the cash flow statement, we can see that the figures are the same. Therefore, we can safely say that the difference in the cash flow statement were all accounted for.